Okay, let's just dive right in. If you've spent any time at all looking into retirement, you have definitely heard of the 4% rule. It's often treated like this law of nature, Save a huge pile of money, pull out 4% a year, and you're set for life. But if you're one of the many people dreaming of leaving the workforce early, there is a critical question you really need to ask yourself. Is this simple rule really a bulletproof plan for your financial freedom? Or is it more like a ticking time bomb, just waiting to blow up decades of your hard work and savings? Seriously, for anyone planning a retirement that's going to last longer than the standard, this might be the most important question you ever answer. So to get to the bottom of that, we first have to understand the fundamental flaw that's been kind of hiding in plain sight this whole time. And to do that, we've got to go back to where this whole idea even came from. Yeah, the 4% rule wasn't, handed down on stone tablets. It was created back in 1994, and it was based on historical market data. It was designed with a very, very specific person in mind, the traditional retiree. Think someone hanging it up around age 65. And that right there led to its single biggest, and you could say most dangerous assumption, that the plan only needed to work for about 30 years. And here it is. This is the core of the problem. The math that works pretty well for a 30-year retirement, well, it just can't hold up when you're planning for 40, 50, or heck, even 60 years. The timeline for an early retiree is a completely different animal, and trying to apply these old rules is, well, it's just a recipe for disaster. So here's the bottom line. When you stretch a plan that was designed for a shorter time, it doesn't just bend a little, it breaks. The probability of you running out of money goes from a small, manageable risk to a terrifyingly high one. The plan becomes incredibly fragile, right at the moment you need it to be the strongest. Now, this fragility, it isn't some vague theoretical danger. No, it has a name, and it is the silent killer of so many early retirement dreams. It's called sequence of returns risk. I know, it sounds like some complex financial jargon, but the concept is actually pretty simple and honestly deeply unsettling. It just means that the timing of market returns matters a lot. To put it another way, retiring into a raging bull market versus a devastating bear market can completely change your outcome, even if you have the exact same amount of money saved. And this risk, it creates this awful vicious cycle. Just imagine, you finally retire, and boom, the market immediately tanks. You still have to pay your bills, right? So you're forced to sell your investments at rock bottom prices. This permanently damages your portfolio because those shares you sold can't recover when the market eventually bounces back. You've essentially locked in your losses at the worst possible time. This is really the heart of the danger. A temporary dip in the market becomes a permanent, irreversible loss in your personal portfolio. You're draining your nest egg when it's most vulnerable, and those dollars, they're gone forever. It's a wound that's almost impossible to recover from in those critical early years. Okay, so that's the problem. And yeah, it's scary, but it is not unsolvable. The answer isn't just to chain yourself to your desk for another decade. No, it's to build a smarter, more resilient plan. So let's talk about what that actually looks like. The whole goal here is to avoid that one more year syndrome, where you're just too terrified to ever pull the trigger on retirement. So instead of relying on a rigid, decades-old rule, we need to build a flexible system, one that can actually respond to what the market is doing in the real world right now. This brings us to a much more intelligent approach, a dynamic withdrawal rate. A really popular method uses something called the CAPE ratio. Don't worry about the jargon, it just stands for cyclically adjusted price-to-earnings ratio. In simple terms, it's just a way to measure how expensive or cheap the stock market is at any given time, and you use that data to adjust how much money you can safely take out. The logic here is really just common sense. When the market is overvalued and seems way up in the sky, the system tells you to be more cautious. You withdraw a smaller percentage, say 3.5%. But when the market is cheap, maybe after a downturn, the math shows that you can safely withdraw a higher percentage. See? You just adapt to reality. Now, I know what you might be thinking. A variable income? That sounds incredibly stressful. Do I have to slash my budget just because the market had a bad month? Nope, absolutely not. And that's why this next part is the real key to making it all work without the anxiety. This is where strategy meets real life. So let's say you run the numbers, and your dynamic calculator says the maximum safe amount you can withdraw this year is $8,000 a month. Now, the tempting thing, of course, is to build a life that costs exactly that much. But the smarter move, The real pro move is to intentionally design your budget to require less. Let's say only $6,500 a month. And that $1,500 a month gap you've just created, that's not just leftover money. No, that is your shock absorber. In good times, sure, you can save it or reinvest it. But in bad times, it becomes this powerful, built-in safety net that completely insulates your lifestyle from what the market is doing. And this buffer, it does so much more than just protect you from a bad year in the stocks. It protects you from, well, from life. It's for that sudden spike in inflation that makes all your groceries more expensive. It's for the unexpected medical bill or the leaky roof or a dental emergency. It's the financial breathing room that lets you handle real-world problems without ever having to panic or sell investments at the worst possible time. So what this all means is that by combining a dynamic, smart withdrawal strategy with an intentional budget buffer, you really get the best of both worlds. You have a plan that is mathematically sound, but it also gives you the emotional confidence to actually stick with it when things get scary. You basically strip the fear right out of the equation. Ultimately, financial security in a long retirement isn't about blindly trusting some simple rule from the 90s. It's about building a system that is robust and adaptable. It's about having a plan that is designed to bend with the market turmoil so that it never, ever has to break. Because moving from a rigid rule to a flexible system isn't just a better strategy. It's what provides true, lasting peace of mind.